Yeah, well, hello, everyone. My name is Miguel Santos. I'm the director for applied research at the Harvard Growth Lab. And, normally when you introduce seminars, you say, it is a pleasure to, and everybody says that. But this time, it is truly a pleasure for me to introduce our speaker today, Gonzalo Huertas, who's truly one of our own in various senses. Gonzalo came out of the MPAD program at HKS in 2018 and started a PhD at George Washington University at a time that we cannot really recollect, but the fact is he's about to finish this year and has been appointed lecturer in macroeconomics at George Washington even before finishing his PhD. Gonzalo also spent a year working as a researcher at the International Institute for Economics, and since mid last year works as an economist of the IMF. So when he talked to me first about his work on balance sheets and debt crisis, I couldn't think of a more appropriate time to bring up these topics to the applied research fellows of the Growth Lab and the public in our seminar. So welcome, Gonzalo. It is truly a pleasure to have you with us.
Thank you, Miguel, for the very kind introduction. It's always great to be back in the CID. That's always been so warm to embrace those of us who are of Argentine descent. I'm just going to go right into the presentation, but please let me know if at any point you cannot hear me or something glitches out. And my understanding is we actually have around 30 minutes for this, but please feel free to if something's not clear. So the main idea of the presentation is to understand the way that balance sheets from the private sector and the public sector kind of intermingle with debt sustainability. Now, what I want to say right off the bat is, of course, as usual, the paper represents our own views and not those of the IMF, which is the usual institutional disclaimer. I wanted to start with this notion that you see in the financial commentaries quite often, which is this idea, for example, when it relates to Japan, that fears about the Japanese debt crisis are overblown because at the end of the day, Japanese households, they have so much wealth that the only actually thing that we need to make Japan's debt sustainable is to just tax those households. And so that collected amount of wealth serves as a repository that should actually give us confidence in the debt sustainability and the fiscal path of the country. And we actually see these kinds of commentaries about the existence of wealth that could be tapped and so on quite often. And so this motivated us to say, well, how much of this sectoral wealth is actually out there? And how does it actually influence the way that we think about how much debt is too much debt? I'm going to start with the conclusions, which is what I like to do because I know some people may need to drop out and also because I want to keep us focused. The conclusions I want to present is, in the 21st century, debt defaults and in general debt crises are still very much a fiscal story. So they're a story about, primary balances, gross financing needs, debt stocks. But even though it's still mostly fiscal, sectoral wealth can actually help predict debt defaults, and it can actually help predict where resources are going to be coming from and where vulnerabilities are going to be coming from. If a specific sector, like say the banks, start crumbling under some kind of specific shock. Here's the outline of the presentation very quickly. First, I'm going to be showing you some very quick stylized facts of how do different aggregate macroeconomic variables behave during a debt crisis. Then I'm going to show you a baseline logic model and basically highlighting that if we only look at macroeconomic fundamentals, we can predict crises decently well. And at the same time, market expectations of default, so if you look at CDS spreads, they seem to track macroeconomic fundamentals. Then I want to move over and show you how balance sheets behave during a debt crisis. Then I'm going to show you an extended model incorporating those balance sheet net worth data. And then finally, I just want to dive in quickly into different case studies of this and that country to show you how we would think about this issue in more practical terms. I know we have some people from ministries of finance from different countries, and I saw that they asked if we could mention some specific cases, so I tried to incorporate that as well, but I don't make any specific promises. let me quickly define what do I mean by debt distress. There is some tradition going all the way back to Kaminsky and Reinhardt of how do we think about a country that is experiencing fiscal duress. I'm going to be taking the Baldacci et al. 2011 definition, which is a country that is experiencing high rollover risk, so sovereign spreads above and beyond 1,000 basis points, or if they suddenly need international financial institution funding, so if they're coming to the IMF, if they're coming to the World Bank to get an extended facility, to get any kind of short-term loan, or in the very case of the early 90s, high inflation. Any of these situations would indicate a country that is experiencing some form of debt distress. Another question is, suppose you're a policymaker facing debt distress. Will you be able to survive this crisis, or will you actually end up in default? And so this is kind of like the separation we're doing for this exercise. And what you're seeing in the right side of the screen is the track record of how many survivor crises did we have in a specific year, and how many actually did we have that ended in default, with the defaults being in orange. And so we see kind of a downward trend up and until the GFC in 2008, and then survivor type crisis and debt duress and debt distress started coming back.
Gonzalo, one quick question. Sorry. Yeah. A very quick question just on the definition of default. Any restructuring, is it defaults or restructurings with private creditors, or also the official? Just on the definition, that's all.
Yeah, and just to complement, and on the dating, so can you be a survivor in a year and then you default, or what is an episode? And when do you count, in which year do you count that episode?
Thank you. That's a 2-1. Let me take them one by one. So first, on the issue of where do the definitions of default come from, any arrears, any reprofiling, or any cessation of payments, any of those situations, we count as a default. We're actually taking the Asonuma and Trevesh database, and we're following on what they're doing. And then all we did was we updated it up until 2019. But it's basically the same definition. So any kind of changing the arranged contracts in any way. Now, when it comes to the timing, if your crisis was a survivor, that means it did not default. So you cannot be a survivor in a specific episode on day one, and then next year you defaulted, and so you graduate to a default. There are exclusive definitions. What can happen is you may be a survivor that was experiencing a crisis in 1990, 1991, 1992, and then rollover risk goes down, and so you're no longer a survivor. So what you're seeing in this graph on the right, it may look like we have a lot of these crises, but some of them may be the same country going more than 1 year into the future. Does that? Okay, great. Now, with these kinds of situations in mind, what we're trying to see is, are these situations different from the perspective of the policymaker? So what I'm going to show you now is how different macroeconomic variables behave across time around the time of the peak of a crisis. When it comes to survivors, this is basically when the sovereign spreads were the highest. That's what we date as T = 0, as the peak of the survivor crisis. And then when it comes to defaults, it's just going to be the year of the default. And I know that we've seen some of the work by Reinhardt et al. That use a very similar kind of structure in their early warnings indicators literature, and this is very, very similar. And what I want to highlight is we think about survivors, at least in our paper, what we see is survivors react to a crisis pretty much in the standard counter-cyclical fashion that you would actually expect. So for example, you see GDP contracting, private investment is going down, and we know private investment is always very strongly pro-cyclical. And the way we see the government reacting is obviously public saving goes down, public consumption goes up. So again, you see the policymaker trying to resist the cycle by expanding all the automatic stabilizers. Now let's turn to the picture of defaults. And we see the same collapse in private investment, the same kind of pro-cyclical variables from the private sector. But not only is the public saving decline less pronounced, we also see that public consumption when it comes to getting closer to the crisis, does not have the same upward reaction. And instead, what starts reacting very strongly is public investment. And this kind of coincides with many of the anecdotal evidence we have discussing with policymakers, that in the case of defaults, you do not have just a policymaker reacting to some kind of economic cycle. You have a very fiscally constrained environment. And so when policymakers start dipping into the funds of public investment, what that means is they're just trying to cut down on whatever they can to bring net operating balances back into equilibrium. Let me get a little bit closer to this idea. When we look at survivors and the composition of government finance flows, we see what I was describing just now. We see the falling net operating balances. But if we look at interest expense, for example, they're actually not that onerous. They tend to increase after the crisis is over, precisely because the government still had access to external financing. And so they're taking on more debt to kind of try to smooth over the cycle. Compared to the situation in which you see the collapse in net operating balances from the default cases. But actually, part of what's driving the collapse in net operating balances is the very onerous increase in interest expenditures, coupled with the collapse in tax revenues. And at this juncture, something we always tend to wonder is, okay, but what's going on with the revenue side? Are they collecting less revenue because just the economy is going down? Or is actually the government doing its best to increase tax revenues, but it just cannot get, for some political or some other institutional constraint, it cannot really make a very strong effort to raise revenues, right? So to answer the question of whether the government is doing an effort to fend off the debt crisis, we look at the behavior of tax rates. And what we see is that for survivors, tax rates tend to be actually very flat. So there doesn't seem to be a very strong reaction or a very strong fear of not being able to meet the debt commitments, except for VAT and a couple of indirect taxes. And for defaults, we also don't see a reaction in the terms of the government trying to find resources to increase its revenues. Actually, we see that although the sample is much smaller, revenues from the terms of increasing tax rates tend to come after default, which means it's reflecting the fact that they have lost access to international capital markets. So the onerous part of raising revenues comes after defaulting and not before. So kind of like to sum up the whole idea of what I just showed you in the stylized facts, we tend to think of defaults as a situation in which the governments are coming into the crisis in a very fiscally constrained environment. So this is not the same as being a survivor that's just trying to fend off a crisis. These guys are coming into the situation with very limited resources, and they're trying to find them wherever they can. And this is going to set the stage for when we bring in the net worth of the sectoral, of the private sector, and it's going to illustrate why we would want to think of households and banks as maybe providing an extra source for revenues. Let me quickly go over the baseline model. We're trying to run a logit with a random effects component, using essentially the components of a standard equation of motion of debt. So that's debt to GDP, GDP growth, interest expenses to GDP, and the primary balance. And we include a serial default dummy just to control for the serial default literature that we find is actually significant. There's other controls that we include. They're included right here, and we also discuss them further in the paper. But this is going to be our baseline model of, can we predict them looking only at fundamentals?
Can I ask you, are the countries in the sample the ones that got into trouble, or all countries at all times?
For the logit model.
Yeah.
So what we're going to be doing now is we're going to be running the logit comparing countries that defaulted and countries that did not default.
But they did not default, but asked for assistance or so.
I see.
So because you had at the first, you had, countries that needed assistance but didn't default, survivors and defaulters. This is not splitting between survivors and defaulters. It's between everybody and defaulters.
Correct.
Okay.
Correct. Thank you. So what we want to do now is we want to zoom in on the defaults and see.
Related to Ricardo's question, I think you might want to also, perhaps in that group, there is a small but non-trivial group of what one would call near defaults. These are, this is Mexico 94, 95, Korea 97, 98, Thailand 97, 98. It is Portugal and Ireland that, these were averted by very large scale interventions. So I think the idea of a near default is something, anyway.
Mm-hmm. Actually, that's both very useful comments. I'm just going to write them down quickly. I agree that the distinction, it would be interesting to conduct kind of like an order probit, right? And we considered this, we just didn't have time. So instead of making it a binary situation, make it a non-crisis survivors defaulters. We may do that in a second stage, but it's interesting to know that there is interest on your part to see the distinction. The reason I want to highlight the baseline model is this is going to serve as a way to see how good our fundamentals are predicting defaults. If we plotted the predictions of the logit, say for the case of Ukraine, right? And what I'm showing you right now is the gray line shows the predictions of the logit model, random effects. The dotted red line is the reaction of markets, so CDS spreads. And the shaded vertical gray line indicates the year of default. And what we see is the fundamentals model seems quite in line with the predictions of market reactions. And it increases also not only around the year of the default, but also around another critical year, which was the GFC. How does the model fundamentals based compare to other countries, right? So for example, for a country that was slightly more stable like Croatia, we see that it kind of trails CDS spreads, but the correlation is actually quite high. For the case of Brazil, for example, which is very different, again, it seems to have a very similar track record. So we see not only that it's behaving fairly well, but also that markets tend to be looking at fundamentals when they're making their predictions. I included the case of Korea because I wanted to make sure that we checked that the model is not actually overspecified, where all the variation is being driven by the GFC, by the Great Financial Crisis. And so for the case of Korea, it's actually not the case. So we see that the indicator is completely flat. And they, just for taste, it's always good to include Argentina to show what a disaster looks like. And in this case, what we see is very strong reaction of the logit around the 2001 crisis, and then an increasing deterioration of fundamentals as we go along that are tracking CDS reactions. So this is the baseline. Now let me tell you about what's going to come next. I've shown you that defaults in the 21st century, still very much a fiscal crisis story, still very much a story about governments that cannot raise revenue, that when they're faced with upcoming debt payments, they try to reduce their spending however they can, and they start cutting public investment. And I've shown you that markets actually see these fundamentals and they react accordingly. And so that's the movement we see with the baseline model. Now what I want to see is what's going on the balance sheet side of the private sector. Particularly consider, for example, the banking sector in survivors, right? And what we see is an increase in the net claims on government as the crisis goes along, which is consistent with this notion that the government can still count on the banking sector to pay some of its liabilities. And this actually plays, for example, a very strong role in the discussions in Spain during their crisis post-2008, because much of the Spanish government was actually involved in discussions, let's say, with the banking sector to be able to place an additional amount of bonds on their balance sheets. That speaks obviously to a robust banking sector that can take on those liabilities. Comparing that to the situation of the balance sheets of the banking sector during a default, we tend to see a very strong decrease in the net worth of other depository corporations, so commercial banks. And at the same time, a very, very steep contraction in lending that actually can begin even up to 3 years before the crisis. The one thing I want to show you before I move on to the model is how household wealth behaves. And so we see also a very steep decrease in defaults for net household wealth that is actually not as severe when it comes to survivors. Again, highlighting the idea that defaults are a much more critical condition than just the survivor kind of episodes, even under the same kind of matching conditions in terms of a definition. Before I explain the extended model and why we're building it, just a very quick primer on where the data is coming from. What we did was we pulled balance sheet data from many different sources. When it comes to the households, Credit Suisse has a very good series of reports they've been compiling since the year 2000 called the Global Wealth Reports, and they have household wealth data and particularly household balance sheet data for assets and liabilities. And then we just used IMF data sets for both the banking sector and the government. Now, I'm going to talk about the government later, but the main takeaway is there is very limited data. So there isn't much econometrically we can do still. We can do some case-by-case qualitative assessments that I will mention closer to the end. What I do want to raise for your attention is we want to take our baseline model, baseline logic model, based only on fundamentals that you would see in a standard equation of motion for debt. And we want to augment them with whatever information we have about the net worth of households on the one side, that's going to be the blue line that I'm highlighting on the left, and with the net worth of the banking sector. Let's say we produce this extended model, again, same baseline variables plus the wealth of these two sectors, and we plot them on top of the other countries we have already produced. So in this graph, for example, what you're seeing is the black line is showing you the predictions of the baseline logic model. The red line is still the reaction of markets. The green line is the baseline model plus the bank's net worth.
Don,
And
can
the
I
blue
come
line
in for 1 second on this with the suggestion?
Yes.
And you have the data in the, which is, you know, and I understand obviously the reason why you also want to look at net, but you have in the middle of a crisis what may be payable debts, but illiquid assets. So the Iceland or Ireland cases, you had massive gross debt. They had to continue payment on the gross debt, but a lot of the assets were illiquid, you know, a lot of it tied up in real estate, blah, blah, blah. And so concretely, I think you might want to explore also the issue of gross indebtedness of the banking sector and related also to that. And this is now on a different angle, moving away from balance sheet, but still in the spirit of balance sheet, which is not about gross versus net balance sheet, but the composition of debt, specifically rollover risk, and whether you see a tilting towards short-term debt. If you can get the data, I think that would also, there is, you know, some evidence out there suggesting that it is a recurring feature that, you know, as the crisis nears, you start to borrow short more.
Yeah, absolutely. I think there is some very good work by Kaminsky on the influence of short-term debt and how you use it as a regressor. The reason, and I think this is a very good point maybe to ponder for an extra minute in terms of the econometrics. We face a very strict challenge between the trade-off of having more countries in the sample and zooming in closer into balance sheets, right? And so, for example, the idea of gross financing needs on the part of the government, which has been highlighted as an important theoretical variable. We wanted to do that, but then we dropped like 30 different countries. So we tried to proxy for gross financing needs with interest expenses, and then we included debt to GDP to consider the more long-term maturities. A similar problem happened with the banking sector. We probably, however, should have considered the issue that you're raising, Carmen, in terms of gross versus net. And I think that would be a very good extension. So I will definitely consider that. There is some very good work on it, but we definitely could incorporate it into the model. The interesting thing about the net worth of the banking sector and the household sector, which is kind of like what I wanted to highlight in these cases and in these figures, is how they can interact together. So the Iceland graph, I mean, Iceland is a very particular country for many reasons, but I'm just including as an example to give you all the feeling of what are these lines that you're seeing, because the graph is going to start getting cluttered. But basically, black line is the baseline model, red line is the markets, green line is the model plus the banks, blue line is the model plus the households. Now, for example, consider the case of Uruguay, right? if we look purely at the fundamentals of Uruguay's pre-default, what we would see is some reaction because of the cyclical nature of its economic contraction. But once we incorporate the indicator of the logit that includes the state of the banking sector, then it just goes haywire. And the reason for this, for those of you who are acquainted with the Uruguayan cases, in the 2001 period, particularly in December, there was a massive flight of deposits from Uruguay to the neighboring country of Argentina. And so a kind of contagion was going on. And this is easy to pick up if you look at the composition of the banking sector's liabilities and assets, but not so easy to pick up if you're only looking at fundamentals. And so an important matter is the logit is showing you the probability of having a default within the next 12 months. So in this case, it goes up right before its crisis happens in the following year. Hungary is also an interesting case because during the GFC, the fundamentals, the fundamentals logit would show you an increase, but not so much of an increase to explain the huge volatility in CDS spreads. And so once again, this is an example of what's going on in the banking sector, right? So if we dig a little bit deeper in the case of Hungary, and we went to what exactly did the standby arrangement request say, the staff report clearly highlighted the main pressure points in Hungary are the public finances and the banking sector, and particularly the fact the banks were having difficulties rolling over maturing foreign currency swaps. So we take this also as a way to match the qualitative evidence with the output from our econometric approach to the issue. Again, as we saw before in the stylized facts, right, the contraction in loans from the banking sector, very clear trend in the before and after of the default cases. Now, the case of Dominica, I find particularly interesting because what we see right before the default is an increase in the indicator of the model that accounts for households, but also an increase in the indicator that accounts for banks. And so what's going on particularly in the case of Dominica? Suppose we were standing right before the default year and we were looking at the financial indicators. What we would see as a traveling trend is the increasing amount in the share of non-performing loans within the banking sector. But then if we dig a little deeper and we look at the composition of the banking sector's loans, what we see is that about half of the entire loans outstanding belong to personal loans. So here we see the interplay of households in crisis triggering a non-performing loan upward trend, which is about to trigger a banking crisis. And so that explains why the blue line and the green line, so the logit with the households and the logit with the banks, are moving up together way more than the only fundamental. Way more than the only fundamentals logit would have explained. Then, of course, you have the case of Ukraine, which is kind of like a mixture of everything together, right? And so Ukraine had a very troubling 2008, but not as bad as 2015, partly because of the geopolitical issues that enveloped it. But if we look at the qualitative evidence showing us what's going on with the banking sector and the household sector, which both seem to be in trouble, what we find in the staff report when Ukraine actually requested an extended arrangement is household real income is expected to deteriorate, and this is leading to rises in non-performing loans. So again, from what we see from the qualitative staff assessment on the ground, it would seem that the logits capturing net worth of these two sectors are actually giving us a very accurate signal of the increase in the risk of default for the country. And then just one final case that I wanted to highlight is the case of Italy, because not everything is necessarily bad news. So in this case, for example, the logit that actually incorporates net household worth, so the blue line, is way flatter than the one that is based only on fundamentals. And so digging qualitatively deeper, and we look at the technical note on the financial situation produced by the fund team, it says that the credit risk from Italian households is mitigated by their net wealth. And so this would act as a buffer of sorts for the position of the country going forward. And so it's useful to see that if we only consider econometrically the net worth of households, it not only acts as a way to predict defaults, but it also acts as a way to predict when default is actually much less likely than if you only consider the fundamentals of the economy.
But
So-
Gon, before your takeaways, but maybe I should wait till afterwards, but what you're doing very much, and I say this is in the Cuban spirit, being Diaz Alejandro was also Cuban, just as a Diaz Alejandro is some sense what you are looking at. You have cases where the part of the problem, or all the problem, or part of it, is on the balance sheet of the banks, whether it's because of the households or perhaps corporates, but in your case, you're flagging households, but it originates with a contingent liability, as opposed to the Italy case, which you just showed, in which the problem is the government rather than, or the vulnerability is the government rather than coming from the contingent liability dimension, which was so important in Iceland or Ireland, or in the case of you showed in Dominica. So you really have two models there, is what I'm saying. The classic, say, Krugman story of, you have, Krugman was talking about a currency crash, but the driver is the government versus the driver also is a contingent liability. Anyway.
Just to add to that, Gonzalo, I'm Andy Neumeyer. When you do the Italy case, maybe a big chunk of the household wealth is government bonds. So it's not looking so good if you take that into account.
Absolutely. So let me get to those two questions one after the other. So the first one, when it comes to Carmen's point, I agree, definitely. Both in the spirit of Diaz Alejandro, in the spirit of more recent kind of like heterogeneity applied models. And so we could look at that, and I'm going to go into the models that we propose in the paper later on and how you can apply this to a usual two-period or infinite household model. But I take the point, and I think you're actually right on that the contingent liabilities are an important part of the story. And obviously, the application of just adding one variable to a random effects logit is going to have limitations in terms of how much you want to stretch it to explain any one case. It would be interesting to have a panel with contingent liabilities. I'm not sure we have that yet, but if you do, I will be very interested in seeing it. And sorry for Andy's comment. Maybe you know more about the Italian case than I do. It is true that if you account for the fact that household wealth in Italy is composed primarily of bonds, then you may have an endogeneity problem. In general, much of the variability that we saw tended to be very closely related to movement in real estate. And so in the case of Italy, this may not be the case. I could go back and zoom in specifically on how their balance sheet is composed. But in general, that tends to be a very strong component of what is driving the change in household net worth. But again, I would be very happy to follow this up and have a more closer discussion of that specific case.
But it's easy, like Italian debt is about 1 GDP. A big chunk of it was held by domestically until maybe the ECB bought it. So you must know how much is the net worth of the household, which I don't, but anyway. What I'm saying is that maybe if you net out the government debt or you put the government debt at market value, the blue dotted line doesn't look so good.
So if I may come in on this, on the Diaz Alejandro story is importantly about the liability side. So, and I think Italian households have relatively low levels of debt vis-a-vis what we saw in some of the other cases. So this is a separate issue from, I think, Andy, the one you're raising on how they hold their wealth. But I think just for Gon, I think also it might be useful. Gabriel Zuckman's paper on the wealth and, the wealth of countries is, I think, whether the wealth is, I think, if I remember correctly from one of Sukman's takeaway, is in the case of many of the wealth measures, it wasn't just domestic wealth, but also wealth held abroad. Italy comes out pretty high on the list, if I recall correctly. But anyway, it's about, I think the point, you whether government bonds are net wealth, I take that point, but I think it's on for the contingent liability story. It's the debt side, not how you hold your assets. Sorry.
Okay, I'm just writing this down because it's actually, both comments I think are very, very accurate. And I will also make sure to get back to you one-on-one with some specific answers. But I look forward to the discussion afterwards. I think you're probably both right. Hang on, how much?
Can I ask a related question? This is Andy, another Andy. Andy Powell.
Carmen is more right than I am.
I have a question which relates to this. I mean, you seem keen on matching the CDS spreads, and that's obviously one interesting thing to do. I mean, related to Carmen's point, another kind of interesting question is whether, whether the banks were a victim or the banks were a culprit. That's another way of putting it, right? And that's a different question. So, because as soon as you start trying to match CDS spreads, I mean, I imagine you can match them quite well, including, all sorts of interesting bank kind of variables, because obviously there's a two-way causality here. So, the banks or their clients anticipating that there might be a default will react in a certain way. And so, that's a very different question to answer. So I think it depends kind of what is the question that you're trying to answer. Are you trying to answer whether the banks are victims or culprits, or the households victims or culprits, or are you trying to match CDS spreads? It's kind of, it will lead you down different paths on empirical strategy.
Absolutely. So for the record, we're not trying to match or track CDS spreads. That would be a completely different research question, I think. I will take your question maybe to highlight something I wanted to discuss at the very end, although I guess I have 3 more minutes to go. But what I would say is we mostly included the CDS spreads just first to show the co-movement with the predictions from a very basic as you could cook up macroeconomics fundamental model to see just how closely are they together. And then to highlight whether we saw co-movements, and this is discussed in the paper a little bit more, robustly, let's say, how much they looked at net worth. But that was basically the end of it. Some quick takeaways I wanted to highlight was we see the household and banking sector's net worth as contributing to future default assessments, both because they may be liabilities or vulnerabilities, as was this, as Andy and Carmen were just discussing, but also for the potential story of, as we saw in the case of Italy, can these sources of resources or of wealth act either as actual revenue for the future or as signals of potential revenue for the future, which kind of leads us back to what we began with, which was the way financial commentators tend to think about Japan. Let me make one more comment quickly, and it's going to be purely qualitative, which is what happens with government balance sheets. Because the problem is, and we saw this in the regression table, there just isn't enough information on government balance sheets yet. So we actually only have the balance sheets for governments for 3 cases, particularly Ukraine, Uruguay. And so any kind of econometrics we apply there are not going to be very, very valuable. But I do want to highlight one interesting point, which is if we look at the case of Ukraine's default, right? And so the dashed line that you're seeing here is just the liabilities in local currency unit. And if you look at the solid line, it's actually the assets. So the liabilities, we computed ourselves because there is no data set, but you can backtrack and do some backward induction. It's interesting that you would think that the moment they became insolvent was when default was declared. And so that would raise some interesting questions of, how in tune is this evidence, quote unquote, with the theory. But then if you look at the actual Greek balance sheet of the government, they were insolvent for a very long time, even before the first and the second adjustment programs took place. So this, I think, is food for thought for how we model how long governments can stretch insolvency. And I wanted to highlight here because Sturzenegger and Levy-Yayati have just published a very interesting working paper with some methodology on how we could construct government balance sheets that I think is actually going to be very informative in order for us to expand this data set that we currently do not have. But I thought this was nevertheless some qualitative information that was useful to highlight. So let me just finish with some quick conundrums. If we look at the case of Brazil in 2015, and here Andy's question may also be relevant, we would see that even if we look just at fundamentals, or if we look at the state of the banking sector in terms of its net worth, or if we look at the net household wealth, we all see very strong signals of an impending possible debt crisis, but the markets did not see it that way. And so this is a question that we haven't explored yet, and it's left for more future practical issues. The second question is, was there a banking crisis brewing in Egypt? And I know we have some observers today from Egypt. And so there's been some research on how Egyptian policymakers were trying to recapitalize and solidify the state of their commercial banking sector. So these kinds of indicators, I think, are interesting to ponder, if market spreads were moving up, just as our indicator of a potential default with banking worth was also moving up, were they also considering the fact that fundamentals seem to be much stronger if we don't think of the banks? And then there's always a question of Japan, right, which we still cannot seem to explain. And I don't want to get into Japan because I know we could discuss it for 2 hours about how specifically Japanese households have a very strong demand for Japanese bonds and so on. But what I did want to highlight is, if we wanted to buy into the story that households in Japan are particularly resilient and have particularly strong balance sheets, our model would seem to coincide with that, right? And so our model would seem to say, if we only look at households and fundamentals, then Japan doesn't look so bad. But if you only look at fundamentals, or if we only take a look at the banking sector, then it looks a lot more fragile. And so that's basically, in a nutshell, a very quick recap of everything we tried to do in this paper. Here are the conclusions again. But basically, 21st century defaults, still pretty much a fiscal story, still pretty much a story of governments that are constrained and that do not seem to find a way to raise the resources to meet their gross financing needs. But the wealth side should actually be considered more often. We would like to see it incorporated into maybe some other frameworks of debt sustainability analysis. That would be one of our final thoughts. And the other one would probably be that we need more efforts to collect better data on balance sheets, particularly for the government. And so the IMF Consistent Policy Assessment Toolkit, they actually are compiling an assessment of balance sheet strength that is supposed to feed into these efforts, but it only began in 2018, so we really cannot do much with it yet. Okay, I'm gonna stop here because I know I've gone slightly overboard, but I don't know, Miguel, if you want to take it away or how you want to handle this.
I would say we still have some 15 minutes to go. So if I don't see any hands up, I will just pick questions from the chat. There's a question by Juan Gotsis on, I wonder if the extended model you're using, it's capturing contagion effects that are not reflected in country-specific fundamentals. And he mentions the example of Uruguay that might be influenced by the Argentina situation. Let's just begin with that one. I had a personal one, but it's just a curiosity. It's been a while since I don't see a random effects model, and I was wondering why the choice.
So the random effects question is probably easier and quicker to answer, but it's basically because of the way we wanted to model this, we had to choose essentially between random effects and fixed effects. And we thought that random effects, which were just better suited to the kind of a priori theory that we had about the behavior of these variables. In fact, you could also run this experiment, that we did run it just using a panel regression or just straight OLS. and you would get similar in terms of the qualitative predictions, we get similar results. As long as the number of defaults as a share of your total cases was sufficiently high, then a probability logit or a panel regression, they will give you very, very similar predictions. But we just chose to run with this one in the end. So, and for the case of Uruguay, I was trying to highlight that point, but I guess I didn't do a very good job at it, which is that if you look at the banking sector, it was actually picking up the contagion effect from the Argentine crisis, right? The problem that one may highlight, and I would share it, is the fact that maybe it didn't pick it up fast enough. But you need to consider that the crisis in Uruguay began in December 2001, when the Argentine government actually froze banking deposits. So it actually was a very rapid crisis. If you look at a year-by-year indicator, it probably would not have been able to pick it up very quickly.
So I have Andy Neumayer and Ricardo in line to ask questions. So given that it's 10 minutes left, I would say that they both ask their question, and then you've got some time.
I have like a short question out of ignorance. When you compute government assets, what do you include?
So that's actually, I think it's a relevant question that I probably should have covered. So the IMF, let me highlight it back. Actually, I think I've lost control of the data set from the IMF that computes the public sector. So this one I highlighted before, the IMF public sector balance sheet data set. It computes everything that the government owns. So this is fixed assets, this is securities, everything except the net present value of seniorage. So which would probably be right, but everything else is counted in there, which it leads to questions of how heterogeneous is the quality of government accounting, right, between certain emerging markets and others. But that's the source of the data.
No, and the maturity mismatch and the fact that most of that wealth is illiquid.
Exactly. Yes, no, absolutely. Particularly the liquidity part, I find very relevant. And it's also part of the reason why, even if we had had a sufficiently big sample, we would have been skeptical about the results. But that was a concern that didn't even come into the discussion because our sample was too small.
Yeah, because there is where Carmen's gross balance sheet thing is relevant. Anyway.
Yeah.
Ricardo.
So well, thank you, Gon, for a very interesting paper. I wanted to ask you about 2020. I know it may be too recent for you, but we have COVID. Countries' tax revenues have collapsed, their spending have gone up, etc. They are wondering how supportive they can continue to be. Whether the big bad wolf is going to come and haunt them, and they're going to face rollover problems or not. But the markets were very supportive during 2020. And I was wondering if your model would suggest that the markets that you overpredict the CDS, that the CDSs were sort of like flattish while countries' fundamentals were deteriorating a lot, or not. And I think it would be, I don't know if you have thoughts on it.
So I have some thoughts on that. I'm a little bit concerned of answering your very sophisticated question in 3 minutes. What I should say is, so first of all, anything that I say does not represent the position of the IMF. But it seems that as long as there is some access to liquidity, right, then the question, we can go back to the question, I hate when presenters do it, but we can go back to the question of, will you be a survivor or a default, right? And so the way I would start looking at a specific country case is, what are your fundamentals? What is the trend of your fundamentals looking like? Does it look more like this, or does it look more like this, right? What is the state of your government finances and the trajectory of your government finances? Does it look more like the survivors' stylized facts, or does it look more like the default stylized facts? And so that's how I would start approaching it. Now, whether CDS spreads, how CDS spreads are going to behave for a specific country, I don't have an immediate answer because we were not modeling in this paper the behavior of CDS spreads. We just include them as an illustrative way to show how markets react. It does go back to the question of, what was going on in Brazil in 2015, right? Why was the CDS spread so muted? It did increase 120 basis points over the span of 1 year between 2014 and 2015 because of the political crisis. But our model suggests we would have expected to see it increase much more, right? So there are some cases that are still quite surprising to us, but that's all I could say about CDS spreads.
My question was more broadly as to, if you want to use this model to say how much can I borrow or can I do, how supportive a fiscal policy can I afford at what risk, how would you answer that question? Today, how much fiscal risk should countries be? How should they think of how much fiscal risk should they take?
So I would use this model to stand on the other side and say, how dangerous is this country given what I know today, right? So give me all of the variables I'm using in the logit, I'm gonna plug them in and see where you are just from the fundamentals. Then give me the data for your households and what their balance sheet looks like, and I'll compute whether that makes me more optimistic or more pessimistic. Same thing for the banking sector. I think the question you're asking also relates to fiscal space, right? So how much more debt can I take on before I explode? And I have another paper in the works that goes to that, but not this model. This model I would just use to keep feeding it information of a country. I would tell you how worried I am that it's going to explode if I was on the buy side. I'm not sure. I feel like I'm not satisfyingly answering your question.
No. I mean, I can invert the model and I can say, if I do X, what will the market say?
Yeah.
Gonzalo, just saying that we have 20 minutes because, anticipating this would be a box office seminar, which it has been. We allowed for 15 minutes more. So I have Carmen, Andy, Powell, and Carlos to ask questions. And I think we've got time for that.
So, Gon, I've really enjoyed, I think this is a very interesting and relevant and promising and all of that. I also think that there's different ways you can parse your sample, because you have cases where the default and the banking problems are intermingled. You have cases in there that I don't think you exploit enough, in which you get a banking problem but not a default. And you have cases where you have a default but no banking crisis. So I think, to look at the dynamic of, I think you might want to start parsing this out in terms of what you're looking for, what intersection of crises, or whether you're looking more at a financial fragility question. I think this is also relevant for the question that Ricardo posed, because right now one of the things that's a concern to me is that it's not just, okay, what countries are going to default, but I think what countries, given what's happened to households and firms, are going to have banking problems as well. So I think you can tease out a lot more. And then I wanted to leave you with some food for thought on a couple of the important issues that you raised that I don't have an answer for, but I think they're quite intriguing. And I suspect, the issues you raised, that sometimes it looks like you're already in a debt crisis well before you are. That is, you're looking really insolvent way before it actually happens. And a couple of things on that I think are worth exploring, which is the role of markets. In those cases, are markets asleep? In that there's the spread is Greece had pretty low spreads going into the crisis as well. So that's one issue. The other issue, I think, the gap between when you show that sort of they already have a solvency problem, and the actual crisis is the issue of hidden debts. And you are, this is a very integral and related to what you're looking at, because you're looking at also all kinds of contingent liabilities, and hidden debts are yet another type. Let me stop there, but happy to discuss, because I think there's a lot here that you can expand on.
Yeah, so absolutely. And the issue of hidden debt seems to be also very relevant when we consider the increasing role of China as a lender, right? And well, I mean, you know quite well, because you've done research on this, that
but
we don't
Greece
actually
had
understand.
Goldman Sachs too. Remember, don't forget that.
Mm-hmm. No, absolutely. I agree.
Andy Powell.
And SOEs.
Yeah, I have a couple. Well, no, and also now the contingent liabilities on because of the guarantee programs that a lot of countries, the public guarantee programs, a lot of countries have implemented across the world. So that's another interesting link between fiscal and firms and banks. But I had a couple of other questions. So the other question I had was, so the way you presented, and by the way, I really like the paper and the presentation was great. So thanks a lot. It's really very interesting. But I mean, you kind of present this as like default is sort of the, you survive or you don't survive, right? But countries survive even if they default, right? And in fact, default, is optimal at some point. So, and then that comes back to the other point, which is, I don't know how much of these other variables are then anticipating default, right? So if the default is anticipated and it's optimal, then of course, households and banks are going to do stuff, and so you may be picking that up in the logit. And I'm wondering how you think about that in the logit. And then I guess just to react to Ricardo's question, I mean, there's a lot of stuff which on composition of debt and composition of the assets that were mentioned as well, which I guess would be important in trying to explain how markets have been quite lenient, through 2020 in many ways, and also, of course, the monetary policy from the north and the liquidity in the global markets, which we hope continues, but we'll see. So thanks a lot. Anyway, thanks for the presentation.
Thank you, Andy. Let me make two very quick, not answers, more like comments or follow-ups, right? So on the specific issue of, you're basically getting to the issue of endogeneity, right? So I didn't include them in the presentation, but in the paper, we do conduct endogeneity tests precisely to check on, on your concern of what happens if households are actually anticipating the default, and so they start adjusting their portfolios or their assets accordingly. What happens if, you could even think that short-term debt is an endogenous function of the probability of default tomorrow, right? And so I think there's an IR Gopinath paper that goes into these issues. And so we conduct endogeneity tests, and we're pretty safe, at least on our first path. And then there was another point that you were making about the optimality of default, right? And so my personal position is I don't usually buy that argument, the argument of governments default optimally. It kind of reminds me a little bit of those papers on hyperinflation that try to model hyperinflation as an fiscally optimal position. And I don't know any hyperinflation that is the result of optimizing on the part of the government. There are a couple of cases in which I think they may be true, right? You use the usual Kehoe model, and you can get a default that is not motivated by fundamentals, but is motivated because it's the best thing for you to do. So in the case of Ecuador, for example, and again, I'm not talking for the IMF, but in the case of Ecuador, I didn't show you the graph, but our model would predict that there were no fundamental reasons to default, and they defaulted anyway. But in general, if I think about a default, I'm thinking of a situation like this one, of a government just clamping down on public investment because they have no resources to go. And so that doesn't sound to me like optimizing behavior on the part of the government. And so that's why I usually tend not to buy the argument so much, but I would not discard it in some cases.
I mean, I think that is the argument, actually, that there's a limit to how much you want to reduce public investment, and there's a limit to how much you want to tax domestic residents or your citizens. So, I mean, these two things are not orthogonal, right? The whole reason, I mean, of course, having strategic default doesn't mean you don't default in the bad times. You will always, I mean, you won't always, but I mean, depending on how you set up the model, but in general, you default in the bad times in a strategic model because the costs of surviving, as you call it in your analysis, non-default, becomes higher than the costs of, precisely because of what you're showing us in this graph, right? That precisely because you don't want to reduce investment more, or you don't want to tax your citizens more.
So I think if that was the case, then you wouldn't. This doesn't look to me like optimizing behavior, right? If you were planning on defaulting, then
okay,
you
let's
would not
leave
have
aside
gone.
whether it's optimal or not. I mean, let's call it strategic, right? It may or may not be. I mean, we have models of optimal. Virtually every model of sovereign default is now a model of optimal default. I mean, they're not liquidity kind of driven models, right? If you like. But I mean, that doesn't mean it's unrelated to fundamentals. That's my point.
No, absolutely. And I would agree with that.
Gonna take a last question today from Carlos, who's been disciplined waiting there. Apologies for the delay. And we're gonna be closing the seminar after Gonzalo's response. Go ahead, Carlos.
Oh, thank you very much. That's a tall bar to follow. I had two kind of related questions on information asymmetry and connectedness and contagion here. I think it goes without saying that kind of sovereign debt restructuring might be in the future. And so my question would be, how much were you thinking about these kind of correlated fragilities and systemic kind of processes when you were trying to think about these different, we'll call them profiles, if you will, and how the Brazils affect the Argentinas and vice versa. Also trying to think about failing gracefully, which I think goes back to Mr. Powell said. It's kind of this idea that, if there is to be sovereign debt restructuring, how much information asymmetry can we get rid of? And what are the kinds of pieces of information that you would like to have, say in the perfect world, to fail, quote unquote, gracefully? Thank you.
So those are good questions, Carlos. I'm not sure how to tackle them in a coherent manner, but I would say, so on the issue of contagion, right? I mean, if we thought about it kind of like in a Calvo way, in the sense of there's some kind of signal extraction problem. So there's some limited number of investors who have access to privileged information, and everybody else is just following them and trying to extract from them whether they're getting margin calls or whether they're actually seeing lower returns in these countries. I think including that kind of structure into a model for these stylized facts would be a little bit too much. And so that's why we stayed away from contagion. The logic in principle should pick up contagion effects the moment they actually start hitting your domestic conditions, right? What it cannot do is it cannot predict based on what it sees outside. And there are the whole early warnings literature, right, is kind of designed to do that. They compute the conditional probability of a default conditional on you observing a crisis within your cluster, right? Those kinds of models, which I think are extremely interesting, but I guess that's not what we're doing. It would have been too much. But I think it's an interesting thing to consider for the 21st century. I don't think anybody has updated them recently. And then in terms of what data I think I would like to see more, I was kind of trying to drive that point at the end, but it's basically, I think government balance sheet data, I think we need more of it. We need to understand exactly what their net worth position is, but we also, kind of separating the liquid from the illiquid. That's why I was raising this Sturzenegger Leveillati work, because I think it's a very good first pass of how would I compute it myself if I had to, right? You kind of like get the discounted flow of all of the possible sources of revenue and so on. it's gonna take a lot of work.
Well, I guess you must be tired, Gonzalo. Thank you very much for sharing your work with us at the Growth Lab Applied Research Seminar. We're very happy to have you as an associate. It's recent, but I'm sure we're gonna make the most out of it. And thanks everyone for your active participation. Stay tuned to our social media for upcoming Growth Lab seminars. Thank you very much.